Hello there, everyone, and welcome to the Final Bar. It's Tuesday, August 6th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, coming to you actually from my parents' house in Cleveland, Ohio. Interesting weather here today with some tornado activity, so hopefully we're able to stay safe and bring you the market update as we promise every weekday after the close. Hope you enjoyed yesterday's discussion with Mary Ellen McGonigal. I was able to sit down with her at the Money Show in Las Vegas end of last week. Really excited that we were able to share that conversation with you. I thought if you're struggling with how to navigate this sort of environment when things seem uncertain and confusing and difficult, go watch that video from that we posted on Monday with Mary Ellen. She's one of the best, I think, at having a very level head and a clear process and a perspective on how to approach uncertain markets. And I think the biggest takeaway was focus on what's working, right? Focus on the charts and the trends that are doing well in the face of market uncertainty. Let's see if we could find some of those charts together as we transition here into our market recap. You know, nice overall recovery day for the major averages here on a Tuesday afternoon after Monday's drop and choppiness. Sort of reasonable to expect a bit of a nice upside recovery today. Now, what's interesting is from around 3 p.m. Eastern on, there's a lot of give back here in the last half hour of trading, especially. A lot more selling than buying. So that last hour, which sort of dominated more by institutions, really indicating further distribution. Signs like that, particularly given what we've experienced over the last week or two, give me pause about being too optimistic about a bounce back up to S&P 5,300. That rotation in the last hour, I think, tells you a lot of what you need to know about how institutions are probably navigating this market, probably lightening up, getting defensive, and we're probably seeing a bit of a nice upside rebound after that initial sell-off. But seasonally, August, September tend to be pretty weak. We're really experiencing that after a major peak as it appears in July. Getting to the details here today, the S&P up about 1% to 5240. The NASDAQ composite up about 1% as well. Mid caps, small caps, all in the green. Very, very similar. No real differentiation. Sort of all equities. Sort of nice bounce higher after the weakness. You see the VIX down about a full 10 points. Now, intraday, yesterday, the VIX spiked all the way up to like 40, 50, 60 kind of range. It was pretty insane how quickly the VIX accelerated to the upside. But for now, finishing the day around 27. So down about a 10 points from yesterday. I would say, again, the VIX spiking above 20 for me tells me we're in a correction phase of some sort. And now it's less about whether we're in some sort of correction. I think we are. Now the question is how long, how protracted in terms of time and price does this end up being? And that's where I think the tools of the technical analysis toolkit can be vital for trying to sort of track that pullback, looking for signs of accumulation, right? Looking for signs that investors are starting to buy weakness. I'm not seeing enough of that certainly yet. This still feels like the primary trend remains lower. Now, rates popping higher today. All the trends that were sort of magnified Thursday, Friday into Monday reversing today, right? So we had weaker stock prices bounced up a little bit. We had interest rates coming down today, really following through from yesterday with a bit of a sell-off in bonds after the gap higher. And so you can see the TLT down over 2% today, rates overall moving up a little bit. The 10-year yield finishing today just below 3.9%. That's after yesterday, we're just below 3.8%. At the close. Dollar index up about 1/3% today. No real danger sign there at this particular moment. Commodities overall more down than up. Note that silver and gold prices were down slightly, less than 1%, but the GLD down to just above 220. Silver prices just below $25 a share. Cryptocurrencies overall bouncing nicely. Now, you'll notice if you look at the price range, though, the y-axis here a lot lower than it was recently. We'll bring up a chart of Bitcoin here in a bit, time permitting. It's up about 5% today. It's a nice bounce after quite a bit of weakness, right? Bitcoin has been testing 70K for quite some time. We're dropping down, actually tested 50K. And I know you've heard me say this again, but to continue the broken record approach, big round numbers, particularly the 10,000 increments on Bitcoin, often become pretty meaningful. So as Bitcoin is selling off aggressively below 70, below 60,000, I'm immediately thinking of 50,000 as a potential area of support. Look at where we've bounced off of in the last 48 hours, almost exactly at 50,000 before we bounce up currently between 56 and 57,000. Looking at the 11 S&P sectors, again, nice recovery day, still one of the most defensive sectors at the top of the list. REITs were up the most, about 2.2% higher, but notice that all 11 of the S&P sectors managed to be in the green today. Financials are number 2, up 1.6%. Technology, number 3, up 1.4%. On the downside, you have healthcare, materials, and energy all up, but about 0.4 to 0.7% for each of those. We do want to spend a moment here talking about the market trend model. I'll bring up a chart of that here in a minute. I want you to note, again, I formally update the model every Friday after the close. Now, we did see quite a bit of deterioration, of course, last Thursday and Friday. That was enough to put the short-term models, if they were not bearish by last Friday, they certainly are now. As the week is progressing, particularly after Monday's session, you can see that the medium-term model for mid-caps and for the NASDAQ 100 potentially turning negative. And again, as of last Friday, those were not there yet. Don't update it formally until this coming Friday, but I do want you to note that we are seeing a bit of a weakness there. Looking at the Magnificent Seven stocks, these are these leadership growth names like Meta up 3.9%, Nvidia up 3.8%, Netflix up 1.8%. Only 2 of these were down. Apple and Alphabet both less than 1% lower. So if you didn't know what else was happening in the last week and look at these numbers, you probably think, decent up day. That's kind of nice condition. You have to remember Nvidia, Meta, and others are bouncing off of a quick and aggressive sell-off here over the last week or two. Let's go to a daily chart of the S&P 500, just see what's happened here. Again, we didn't have a live show on Monday because we wanted to share Mary Ellen, my conversation with Mary Ellen McGonigal. And again, make sure you check that out here. Here was yesterday, right? So that was Thursday's bearish engulfing pattern closing right at the 50-day. Here's Friday with the lower open, the gap below 5,400, closing around 5,350. Here's yesterday, a Black Monday in air quotes, I guess, a blackish Monday with an open around 5,150, closing just below 5,200. But again, testing that 5,250 level. Today, a nice continued bounce here. Now, honestly, if the market was to go much, much further lower, this particular phenomenon of a counter trend rally is incredibly normal. And this is why I would caution you from being too optimistic from yesterday and then into today and getting a bounce higher before you sort of mentally declare this an all clear that things are all great and conditions are just going to get better from here. Let's remember the fact that we're still down quite a bit from 5650 where we were in mid-July to 5250, which is where we spent some of our time here today. We're about 400 points below that all-time high. So overall, the market is clearly making a pattern of lower lows and lower highs. It's reasonable that we bounce a bit off of oversold conditions like we experienced as of yesterday's close. But overall, I would expect further deterioration until you see enough signs of accumulation. Just one day off of the low, not enough for me. I'd want to see more and more confirmation of that particular rotation. Here's our market trend model, as I mentioned. And what's interesting is the short-term model turned negative 2 weeks ago Friday. So overall, we remain most likely in a bearish condition, barring some huge rally with the S&P over the next 3 sessions. But worth noting, here's the medium-term model, very, very close to that 0 level. We'll see as the week progresses. If we get some further weakness Wednesday, Thursday, Friday, very reasonable to expect that medium-term model to turn negative. The last bearish signal we got from that medium-term model where we had been bullish and turned negative was in September of last year. Now, if you look, after that sign that the medium-term trend model was negative, we had another 6 weeks of that market going lower, of the trend model remaining negative before finally we got the bounce off of the October low. So what I found is when that does turn negative, in my experience, it's best to let it play out. It's not a great opportunity to, make assumptions about whether that's going to recover or not. Just be patient and wait for the positive trend to reemerge. So very, very close to getting that medium-term sell signal for the first time since September of 2023. A number of other things to talk about in terms of breadth conditions. I'll just leave it at this. The breadth overall had been very, very strong in the month of July, right? So the market had been coming down as measured by the major equity benchmarks, but A lot of individual stocks, particularly in value-oriented sectors, especially in defensive sectors, are actually doing quite good. As a result, the breadth conditions remain quite robust. In the last week, we've seen breadth rotate negative quite aggressively. The McClellan oscillator now firmly below zero, less than 50% of S&P stocks above their 50-day moving average. That was a big change from mid-July, where it was around 75+% above their 50-day. So about a quarter of the S&P have broken their 50-day just in the last couple of weeks. And I think that tells you a lot about the pullback that we've experienced. And a lot of times, again, that can be a sign of further deterioration. Now, the long-term breadth is still quite fine. We're around 66%, two-thirds of the S&P members above their 200-day moving average. So we haven't had that waterfall decline getting below that level of support. So the S&P 200-day moving average just around above 5,000. So we'd have to have a bit more of a sell-off to trigger that particular breakdown. But a break below the 200-day moving average is a very big red flag in my opinion. Most stocks in the S&P remain safely above their 200-day moving average. I think that's worth pointing out here. Interest rates bouncing up a little bit, but the overall trend has been much lower. Now, the trend in rates was lower really from the April market low for the S&P 500. As the S&P was trading higher, rates have been steadily declining, right? So the 10-year yield is around 475 here in late April. Late July, all of a sudden we get down to below 4%. Of course, that accelerated down from mid last week. That was around the Fed meeting last Wednesday through Monday's session. 10-year yield really rotated lower aggressively. Today, bonds sold off a bit, bounced higher. I think that trend of higher bonds and lower rates is probably still the larger trend. This feels a lot like a counter trend bounce. And it's interesting to note that we're right at that December low, the February low, right around that same point, right around 3.8%. That's kind of where we ended up yesterday. So a bit of a bounce off of that level makes sense. But watch rates to keep going lower. Think about what stocks and sectors tend to do well in that particular environment. I do want to point out I did a YouTube video earlier today on my YouTube channel called Market Misbehavior, so check that out. We talked about the VIX, elevated volatility, and one of the charts we looked at was this one. Wanted to point out the fact that high yield spreads have really started to widen out. When I'm thinking about a market in a bullish phase that starts to rotate, right, sort of that classic topping signal, what kind of things would tell me there's an elevated risk of further deterioration? Two of the things on the list, besides the S&P breaking down, which I think it already has begun to do, of course, would be a spike in volatility, and we've seen that with the VIX accelerating to the upside, and a widening of credit spreads. And we're looking at the high yield option adjusted spread here going from around 3% to almost 4% in just about a week. What that tells you is that bond investors that invest in junk bonds are seeing elevated risk. As a result, they're demanding wider spreads or wider, bigger spreads above a risk-free bond like a Treasury bond. So widening spreads usually coincides with risk assets rotating lower. So high yield spreads widening, volatility increasing makes sense with the S&P going down. If what I just explained did not make sense, check out my my YouTube video on the VIX and other VIX-y sort of sentiment things to pay attention to, including option-adjusted spreads. Let's look quickly here at the chart of Bitcoin because it continues to bounce off of big round number support, as I like to call it. Again, I like to reflect on the fact that big round numbers tend to have meaning, and that's not just something I've made up. It's been widely documented that big round numbers tend to have meaning. A lot of that was attributed in early analysis that I saw years ago was the fact that humans were placing orders and you would naturally gravitate to big round numbers. Also, it was shown that when a stock would be below $100 a share and then go above it, $100 is sort of an arbitrary dollar value. It doesn't necessarily mean anything, right? If something's 99 to 101, that doesn't really mean anything different. But to a human investor looking at the chart and seeing it go from a 2-digit stock price to a 3-digit stock price, you start to question, okay, hold on, is this really worth over $100 a share? It's really deserving of that sort of level. And I would argue that that sort of mentality probably still fuels at least some decisions here in the market. So when when Bitcoin tends to find support at 60,000 or tends to find resistance at 70,000, or as we've experienced in the last 48 hours, finds support almost exactly at $50,000, I am not surprised at all. What I'm surprised is that people don't follow those levels more closely. Here I'm showing my chart of Bitcoin with big round numbers and horizontal lines. There's 40,000, here's 50,000, there's 60,000, here's 70,000. look how often that we tend to hit those levels called pivot points, right? If we're below, we tend to reverse off of there. If we're above, we tend to bounce off of those levels. So Bitcoin oversold as we hit 50,000 to me is a clear bounce higher. The question, of course, same with the S&P and other risk assets. Do you see signs of accumulation? More of a rotation from distribution to accumulation. One day doesn't do it for me. I'd like to see a little bit more of that, and I would be keenly focused on 60,000, moving average resistance a little bit above current levels to see if we're able to eclipse that potential area of resistance. Let's finish off looking at some individual names that I think are worth paying attention to. We'll start with two stocks that are earnings names from Monday and appear to be bouncing off of their 200-day moving average. Paul Tudor Jones famously said, nothing good happens below the 200-day moving average. And to summarize what I think that means, pay attention to when stocks are able to hold that, right? When things are below there, that tells you the long-term trend is down. Wait until they're able to get above a 200-day moving average. And when they're above it, look for that to stay there. Look at how PLTR opened yesterday at the 200-day moving average. By Monday's close, we're at 24. Today, another 10% higher. We traded a little bit off the open, but I like that bounce off of the 200-day moving average. I'm also noticing how the April, May, early June lows are right around $21 a share, which is basically where we bottomed out on Monday's session. So I think a reasonable bounce off of a key support level and the 200-day moving average. It's what we call a confluence of support. Here's Caterpillar, a bit of a similar read, and you can see another one bouncing off of the 200-day, which is around 310. Yesterday, we opened right below that level and traded back above. Today, again, finding support at the 200-day. I like stocks that are able to find support at a key long-term moving average. I don't have a problem taking a shot at a chart like this and then using that moving average as a potential stop, right? And sort of limiting your losses to a hold of an ascending 200-day moving average. I think that could make some sense for you. But think about whether the stock like Caterpillar is able to hold the 200-day can tell you a lot about the longevity of this uptrend. Recent times in October of last year, in really spring of 2023, we undercut the 200-day moving average briefly, but the bounce back above the 200-day was a clear sign of the reemergence of a new uptrend. I think I would keep an eye on Caterpillar for a similar sort of pattern here. After the close today, two stocks to highlight for you. Super Microcomputer, which was one of the most widely followed stocks in 2023, had those incredible exponential rises from being down in the mid-double digits in late 2022, going up almost to $12.50 a share earlier this year. We're now back to about half of that value, currently just above $600 a share. They reported after the close today. Let's check in on the aftermarket trading, see what sort of thing we're seeing. It's up about 3.4%. Now, the after-hour session is pretty noisy, so I don't like to spend too much of time drawing dramatic conclusions from that. It usually is good for an instant reaction from an earnings report, but you really want to look after that to see what sort of things happen. So keep an eye on SMCI for now, bouncing up a little bit in the after-hour session. Rivian, RIVN, is another one here. I like this particular trade because it's pulled back to, again, the 200-day moving average from above. And I'm not seeing any after hours session right now, so I'm not sure why we're not loading that. Oh, there we go. It's down about a third. I was going to say, should be loading here. Yeah, down about 1/3%. So no real significant change from today's close, up about 1.3%. Interested to see on a chart like Rivian if it's able to hold moving average support. This is after bouncing above there. Lucid is another name that reported, I think, today or yesterday, and again, trying to get above the 200-day moving average. For things like Lucid and Rivian, obviously these have been in long-term downtrends, I would argue. Chart of Lucid has just been, below a downward sloping 200-day moving average for so long. Now it bounced above there in July, but has not been able to mount any significant follow-through above that level. Now, again, we're continuing to trade right around the 200-day. Stocks like this, you really need to see a higher low and then an improvement from here. We'll see if it's able to do so. With Rivian, same thing, right? You're sort of having a nice bounce of higher lows. Can we continue to find a foothold above the 200-day moving average? Can the RSI hold around 40? If so, I think that would complete a nice sign of accumulation off of an April low, and I would think that's something maybe worthy of your attention. Two other names actually reporting before the open tomorrow that I would keep on. Shopify, obviously one of the big payment processors, online retailers, or facilitating online retail. This is a stock that failed to get above its 200-day moving average in June and July, now undercutting the May low. We're kind of down at the October 23 low again. So think about how far a lot of stocks are above that 03 low. This is one that's actually round trip back to that support. Do we find accumulation? Are earnings a catalyst to push higher? Disney, another one, obviously an entertainment name, a broad sort of media conglomerate, has been in a primary downtrend really since April. Lower lows, lower highs, now below a downward sloping 50-day moving average. The RSI clearly in a bearish range. This is one of those stocks where I think has not shown enough signs of accumulation to deserve your attention yet. We're getting very near the October 23 low, around $80 a share. Interested to see if we can get an upside gap with earnings tomorrow before the open. And again, back above the 200-day moving average, around $100 a share, could be a nice sign of upside follow through. But let's let the chart tell us when accumulation is happening. Higher highs and higher lows, I think, are incredibly necessary to get excited about a name like Disney. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.